Welcome back. It's another week, 9 to 5 Investors, Sunday service. It's your host, Mr. Smart Money, co-host, Mr. Legendary. We got the scalper in the building, surgeon right here by my side, and we got a new part of the family that came in, Tree.
Yeah, get her investor. You gotta get an investor name.
Yeah, we're gonna come up with a name for you, Tree, but your investor name.
Hey, okay.
But yeah, man, y'all know what it is. It's another week, the 9 to 5 Sunday service. I'm gonna go ahead and start it off with the disclaimer.
Yes, it is yours truly, Mr. Legendary, one half of the Splash Brothers. This is the 9 to 5 Investor Sunday service.
That's some more, G.
We are not financial advisors nor fiduciaries. All content shared here is strictly for educational and entertainment purposes only. With that being said, every investment you make on the market comes with inherent risk, so please do your due diligence.
And there we have it. So this week, y'all, I'm gonna go ahead and let y'all know we got a little special segment. I don't even know her investor name yet, but we're gonna bring my daughter on Tootsie so she can show y'all some of these charts. I gave her a crash course on support and resistance. Ray Bay gonna help out Tootsie and Ray Bay gonna join the show.
Ray Bay's on punishment.
She can do the same thing.
Our future 9 to 5ers.
I love it.
Oh, hold on. A correction to the name. Ray Bay has an investor name.
Uh-oh.
Big money.
Big money?
Yeah, she said she big money.
Okay, Ray Bay.
All right. Y'all come in and say what's up to the people real quick. And we're gonna let y'all show them how to chart.
Come on, Trey.
Big money just stepped into the scene. Say what's up to everybody.
Big about her. Nothing.
Hey, Big Money.
You should be small money.
Hey, Troy.
Everybody know it's Tootsie. So
Troy the Trader.
that's gonna be your investor name, Troy the Trader. You don't like that one?
You don't like that one?
All right, we're gonna have to come up with a different one.
No, my investor name is gonna be Beat Up Uncle Jermaine.
Oh, that ain't no investor name.
Oh, Lord.
All right, somebody give me a company. I can't think of one off the top of my head. I ain't did yet.
What about Chewy?
Chewy, yeah, I might not have did that yet.
Chewy, y'all like puppies, right?
Yeah, let me just clear the drawing. Crypto maniacs in the building.
Uh-oh.
What's up, Crypto?
Wario.
Hey, nah.
Big
Hey.
Crip.
Peace, y'all. What's going on?
What's up?
Nothing, man. Just getting up.
They act like they don't know what time it is, G.
My boy coming in sounding like Barry White.
All right, y'all. So this the year and the day chart for Chewy. The concept that I told them was when we first put our what we call resistance line, that's what we call the pickup point for my teaching method for the girls. Where the support line go to is what we call the bouncing spot, or where it bounced from the pickup. So just with that basic concept, we're gonna have them plot support or resistance on the year and the day chart. So we're gonna start with the pickup line. Let's zoom in a little bit. Our pickup line, we're gonna put the pickup line right here. So if we pick the ball up right here, where I'm gonna stop at, where y'all gonna put for the first bounce at, where it bounced at. Y'all do it, put the point on there.
What? Come on, we got time for this.
I would say where the most lines are.
For the bounce. You pick the ball up here, where do it look like it bounced?
Right here.
Click. So from right here, this now becomes our pickup line. that we picked it up right here.
Troy, put your line on it.
Troy, where did it bounce at?
You pick it up right there?
Yep, from this new line that we just drew.
Use the mouse, Troy. Use the thing.
Where would you put the bounce line at?
When it dropped,
Yeah,
I'll say about that.
put your line. Nope, get it on the right spot first. Make sure it's on the right spot. You gotta put it at the bottom. All right, so Raylan, it's on you now. You got this pickup line. Where would you put the next bounce to?
Right there. Right. No, that one. Maybe right here.
Put it right there. Set it. Extend it. You don't remember how to do it.
I haven't done this in
All right, Tootsie. We got this pickup line right here. So from right here, what would you say it bounced at?
right here.
Put your line on there. And we're gonna do one last line, right? And if we picked it up right here on this line, where you gonna put your last line at?
Right. Where?
All right. So we got a resistance point, support. Then we come down, we got another resistance and support. And this turn around and act as resistance and place support right here. Same thing over here. Who else could we have pull up a chart? Jermaine, you could pull up a chart on your tablet, Chewy, real quick and pull up and plot some lines, see how close they is.
Oh shit. They did those?
Yeah.
They cheated.
Jermaine say y'all cheated.
They did a real good job.
Who helped y'all put the
You're not
lines up
cheating.
there?
You cheated.
Who helped y'all put the lines up there?
Copy that file line.
Yeah, I'm gonna copy y'all's. Those are good lines, actually.
Mm-hmm. Real good.
They say y'all did good.
Y'all did a good job.
And see, this was, like I say, this ain't even overcomplicated. We just did the concept of picking up a ball right here. Based on the candles, that's the momentum of where the ball was moving and bouncing at. So we picked up the ball right here. They see a good bouncing line for right here. All these touches on their line, that's a good support level. So the concept of charting is not overcomplicated. I simplified it to where the 8 and 9-year-old daughters could chart out companies now with a year and a date information, 3 years, max chart, whatever time frame. Just that concept of picking the ball up, where did it drop to?
All
There
right.
you have it. An 8-year-old.
Good job, y'all.
Come on. Say bye.
Bye-bye.
If an 8-year-old can pick it up like that, there's no reason why we can't. Good job, ladies.
I'm not 8, I'm 9.
Okay, a 9-year-old, my bad. Good job, Big Money.
All right. So, any news this week that we want to talk about before we get started with the lesson?
Yes, I got
Baby.
news updates.
No diet on everybody's tongue right now. That thing had
Yeah,
a
we'll
run.
start off with Dodge.
Money. Yeah.
Money, huh? Yes, sir.
We know Dodge had a tremendous run these past few days. A lot of people made some money. So now, the question I want to present to the group is, what do y'all see Dodge going from here?
Right.
Do you see it being a viable crypto coin moving forward? Do you see
it's a very underrated I think, because like for example, Mark Cuban, he's setting up Dogecoin machines in his arena where people can actually pay with Dogecoin. And yeah. So I mean, with that news, and I think Coinbase IPOing had a lot to do with it too, because I noticed right around when Coinbase, you know, that news came out that they was IPOing, Ethereum went up a little bit, Ripple went up, and Dodge started to go up. So I think the Coinbase IPO kind of brought more overall attention to the cryptocurrency as a whole.
My thing with that, what I believe is, I think because it started off as a joke, you got real investors, they can't take it serious. Like, or they don't want to admit that we can now start paying attention to Dodge. They don't bash Dodge for so long for them to come back and be like, man, I think we can invest in it. It's kind of like contradicting what they had already believed that it was going to be. So because it started off as a joke, that shit ain't funny no more. It's like, if you took $1,000 in 2019 and just kept it on there and kept, you know what I'm saying, putting your monthly investment into Dodge, people made millions of dollars that fast just because Elon tweeted about some shit. So really, it's like but Dodge do this. They'll go up, they'll go down. But when I look back at it, every time they went on a little run, they'll go down. But every time they came back, it got higher and higher. Because remember the last run, just this year, it went up to 8 cents, dropped back down to 4 cents. But then this time it went up to 44 cents. So now they're back in the 28 to 30 cent range. So next time it pump, will it push over the dollar?
Or finally meet the dollar.
Right. So it's like every time it's gonna dip, we already know that because it ran too long. It's for them. It's gonna dip, but then next time, the next push is just gonna keep pushing it up and up.
And see, I also see an interesting story coming behind Dogecoin now. You know, with crypto, we got to pay attention to how it's going to be integrated for it to be stable as far as being used a lot. We see the story, like he just said, with Mark Cuban. Now we also seen the story that we posted in the Discord by the restaurant in Manatee, allowing their customers to start purchasing their meals with Dogecoin now. That's another sign of integration. When Bitcoin was a laughing stock, it finally began to peep its head into the mainstream when people started to take it seriously. Then it made all these leaps and bounds from 10 to where it's at now to 60 grand. And it's now becoming further and further integrated in the mainstream society. And now you got other coins starting to get in with that trend. It's becoming the real thing. It's not just a joke no more. So a lot of these coins that we've been looking at as just something to play with because we can't afford Bitcoin, is not going to become some main players in cryptocurrency where we're going to have a nice position. Dogecoin going to be one of those players as long as they continue to further integrate into mainstream society.
Okay. So do y'all feel like there's a renaissance going on in the investment world as far as the social media element? Because
I think so.
I think so. I absolutely think so.
we saw with companies like AMC and GameStop.
Mm-hmm.
They were on the brink. They were on the brink of extinction. And then the Reddit crew came in. They say the Reddit crew or whatever came in and pumped the stock. Now we're seeing GameStop reconfigure their board, reconfigure their brand, their business model. GameStop's now talking about going into NFTs, which is another element that kind of was ushered in by the social media era, you know. So we're looking at the way how things like the Reddit crew and social media can influence the market. But now with Dogecoin, it's not only influencing the market, but it's kind of like giving Wall Street an inside view on innovation. Like, this is just what I'm seeing. Like, for years, we considered Wall Street as the smart money. But now that we have the internet, you have retail investors that have access to a lot of the information that the investors getting on Wall Street. Now, they don't have access to all of it, but what they make up for it, what we make up for it being the millennials, the millennial age, we have a more keen familiarity with technology and the things that's going to be popping moving forward than maybe the Wall Street investor does. The average Wall Street investor consider that smart money, the Warren Buffetts of the world, the Dalios. These guys are like in their 60s, 70s, 80s, you know. They're older guys. They were used to the way the world was before, when oil was dominant on the market. But now that tech is becoming a dominant factor on the market, I kind of get the sense that maybe they're a little out of the loop as opposed to the average retail millennial investor who we can kind of see these new technologies and how they can be applied on the market or in the real world. For example, like a Dogecoin. Dogecoin, like she said, started out as a joke, but who was it a joke to? The smart money, the smart money investors. We've been in, a lot of us was in Dogecoin early on when it was less than a penny. So is it something that, well, more and more we're seeing that investors, the retail investors, the social media investors are moving the market or directing the market to where to go? Because now I'm pretty sure this Dogecoin thing combined with the Coinbase, I'm pretty sure that played a factor in the way the market performed later on in the week. A lot of stocks were down, and my theory is that a lot of people were taking money, taking profits, and moving it over to the crypto.
Yeah.
Buying Dogecoin because they saw it going. Because at some point, even if you smart money, you see this thing running, you gotta nibble. Gotta nibble at the bait. So are we starting to see like smart money starting to nibble on this Dogecoin when we was already on it, been in it since when it was under a penny? Is the retail investor now moving the market, directing the market, and then the smart money following? That's just something I'm thinking about when I see like stories like Dogecoin. Now they're starting to find functionalities for it. You know what I'm saying?
Even now, some airports are starting to implement, you know, cryptocurrency machines in the airports. Right. You know, the airports now, they don't even take cash no more. Like Tampa Airport don't even take cash no more. You got to either go put cash on your card, you know, something like that. So it's like, you know, we transitioning like slowly but surely. And like you said, the smart.
Is it that we see the transition before the smart money? Because when we look at crypto, even look at crypto right now, more and more institutional investors, they getting bullish on it.
But that's the thing with that. The thing with that is, I think everybody can see it, even the old people. But you know, old folks get set in their ways. So you know, I mean, some people, they see the transition and they're trying to fight the transition because it's not conducive to their bottom line. Because it's like, I've invested, like you said, if I'm invested in oil, now you telling me we moving to clean energy, electric, like.
I know about those industries.
Yeah, I'm scared.
So
I want to put out news here, there to make it bearish, to make the, you know what I'm saying, the hype around what's going on to kind of dwindle. Cause I got fear, like I'm not gonna be on top no more.
Right.
Basically, yeah.
Right. Not only that, but You know, if I made $1 billion in oil, I'll probably ride it till the wheels fall off too. I don't care what else you got going on. I made my money right here. I'm staying right here till the wheels fall off.
Yeah, them are bread and butter.
My bread and butter. I might nibble on something over here I might see a little promise in, but I'm primarily focused on this right here. For the last 30 years, 40 years, 50 years, this how I've been making my money. This how I amass my fortune. This is where I'm at.
And to a certain extent, that's good. Then if you go too far with it, I mean, it could be to your detriment too, because you get wiped out when the cycle come through.
When the world change, you die. You either evolve or you die off.
Yeah.
And some people, they don't want to adapt.
Right.
You get those people that say, why can't things just stay the way they are? But you know that ain't life. So, yeah.
And see, remember we brought this up, I want to say about a month ago, maybe a little longer than that, when I was saying pay attention to the transactions, the hand-to-hand transactions of cash versus digital payments. Hand-to-hand transactions with spending cash was starting to decrease, while the digital forms of payments were starting to increase. The shit really playing out.
Right.
But you got with Android, Google Pay, with iPhone, Apple Pay.
That same thing happened with Bitcoin. Now Bitcoin started off more than this, but it was the same shit. People were like, man, what they didn't understand it. They couldn't see how the hell we gonna be paying with shit with digital money. It didn't make no sense back in 1990 something. You know what I'm saying?
Now I want to pose a question.
Millennials was in on the ground floor.
Yeah.
We've been bullish from the start. You know, because we can see it. What they make up in their ivory towers, they can't see it. They detach from what's going on the ground. It's a certain detachment that I think that the social media, they use that as an edge. You know, I'm not saying that we'll be better traders. We better traders than the pros, the Warren Buffetts, but we kind of have a different view of the world moving forward than they do.
And then not only that, we're not necessarily afraid to move our money. Like
right.
when new shit come out, like let's say right now we're talking about tech, but in 20 years there won't be tech. It's gonna be whatever it's gonna be. But when we see that, we're not so stuck in our ways. Like, man, fuck that tech shit. Fuck that. We gonna stay with tech. We're going wherever the money at.
Right. We're more adaptable because we have more tools at our disposal. You got to think a lot of these guys made their bones 30, 40 years ago on the market when they actually had to read pages. They had to go get the actual book. They didn't have minute by minute chart updates like we have. Touchscreen where you can chart out out a company in 2 minutes. They had to actually draw the lines. So we have
to wait on the information. If a company going public, if you're not on the board, it's word of mouth. You gotta wait till that newspaper come out.
Right. So we have more tools at our disposal.
Right. Apple not having no meeting at clock and at 10:30 breaking news. Apple acquiring, you know what I'm saying, CCIV. You know what I'm saying? It ain't. Yeah. It went like
wait for the Wall Street Journal to come out to get the news. Now we get it up to the minute. We get it in real time. We have more tools at our disposal, and being that we grew up in the computer, the internet age, we know how to maneuver and get to those tools better and faster than a Warren Buffett, who probably still doesn't know how to use a computer that well.
Now he gotta hire somebody.
Right. And 9 times out of 10, the person he hiring is a 30-year-old. You know what I mean? The IT guy. So that's where the youth comes in and becomes an advantage. Because they're not even Warren Buffett, he probably not even thinking 20 years from now, he'll be dead. But we are.
But let me ask y'all a question about crypto though. We know why some of the hedge funds gonna add it to their portfolio or whatever for the gains to kind of balance them out for the performance. why y'all think banks and other financial institutions starting to add crypto to their portfolio?
Because they don't want to die.
How do you think it's going to benefit them as far as business structure? Because it is a business. They moving as a business. So it's a business move for them to add crypto.
I think you see a growing number of companies adding crypto to their business assets. Now, some of them they could be just for a hedge. Some of them they using the crypto for a hedge. Some of them are using it because they are bullish on crypto. The CEOs are bullish, like Elon Musk. He sees the functionality in it in the future. And then you have others just buying it just, as a place to hold money, as another asset, as opposed to putting the money in the stocks, buying stocks of the company. They buy some crypto. They see how it's moving. They may not really understand it. They may not really believe in it, but they respect the price movement.
I think some of these plays, as far as the financial institutions, it's gonna come to a point where they're gonna add it as another service for their clients who choose to use cryptocurrency. They'll accept cryptocurrency, but it's gonna be like some type of fees to manage it and all that type of stuff, where they're gonna add on revenue from allowing their clients to use crypto. That's my theory behind it.
Right. Those would be the companies whose CEOs, they see the functionality in it. Like Tesla and Elon Musk. When he said that you'll be able to make payments in crypto. You'll be able to buy a Tesla with crypto. You know what I mean? He sees the functionality. Then there's other companies that have they have assets in crypto on their books, but they don't have a functionality for it as far as their business model.
Mm-hmm.
You'll look and see, man, this company got crypto. They got money in crypto, but why? They don't even. This is not even a type of, those will be the companies that I say will be using it as a hedge. You know what I mean? Keeping a little free cash flow there, maybe. I would.
Mm-hmm.
But let me say how I figured out how it's profitable for a business to accept the crypto. So when we were watching the news, when a company in Sarasota, they're gonna use Dogecoin, right? Mm-hmm. So say a burger costs $12, you're gonna give me the equivalent to that in cryptocurrency. So that might cost you, I think, like 66 coins, right? So those 66 coins may have only cost you $3 or $4, but in 3 years, if those 66 coins now worth $50, $60, you almost paid $50, $60 for a burger.
Yeah. That's why I don't see why people would buy stuff with crypto.
Right. Yeah. And then it's like, okay, so now if you continue to do that and you making all your purchases with cryptocurrency, you spending thousands of coins a week. And it don't seem like it's a lot, but if you're talking about long-term investing, in 2 years, those 1,000 coins could have cost your ass $500,000.
See, this is what we got to figure out. Is cryptocurrency an asset, like an equity, like stocks that you buy and hold? Or is it something that you just use in day-to-day life? Because I don't see how you can do both. I don't see how you can be holding Bitcoin for long-term gains, and then at the same time you spending it on cheeseburgers and pizzas and stuff like that.
Right.
I don't see the it seemed kind of counterproductive to me. So I don't understand. I mean, for one thing that you're gonna have to realize, is it an equity or is it currency? Because I don't think it could be both.
And I think that's the question.
Bitcoin, and then you spending Doge coin for day-to-day purchases, but you holding maybe Bitcoin or something like that. ADA, you holding that? I don't understand. Will it be traded on the currencies market, Forex? These are questions I think they still trying to iron out. At least I'm trying to iron out. I don't know if they already got it figured out or not.
Yeah, I think that's the main, that's the biggest question too. I mean, like you said, I mean, am I gonna hold this for 30 years? I mean, 30 years from now, I mean, if all goes well, you know, the price will, you know, balloon. But then it's like you said, if I need to, you know, pay my rent or something, I'm paying my rent with cryptocurrency, then I got to go back and buy some more to replace what I spent.
Right.
So, yeah.
At a higher price at that.
Yeah. I think what it would be moving forward, it's kind of like, I mean, like, let's say if the dollar is backed by cryptocurrency, kind of how gold right now backs the dollar. That'll make more sense to where we still spending, you know, regular currency, but however, you know, the cryptocurrency is what really gives the dollar its value. If there's some way, if that can be, you know, finessed like that. I'm not sure. I'm just thinking, but yeah.
So let's say in 20 years, right? We doing everything with cryptocurrency. It's no paper money anymore. Everything digital, right? Where would Bitcoin, what would that do for their long-term appeal for as far as holding? How would they still be performing on the market?
Right, but now we
If
ain't talking about
if crypto replaces the dollar, are we now trading cryptocurrency on the Forex? It's a currency.
I feel like you would have to.
Yes, a currency now.
Yeah.
Like for the dollar, we don't take the dollar and invest in it and hold it and wait for it to appreciate. In the stock market, we don't.
Right.
But now that's kind of like what we're doing with Bitcoin right now. We holding it as if it's a stock.
Right.
But in the next 20 years, it turns out to be a currency.
What they gonna do then?
What they gonna do then? How would the price of it keep rising and fluctuating? Because right now it's moving like a stock. But if it indeed became a currency, would it still move like that on the market? Or would it move like the dollar, the US dollar, or the euro?
That's a good ass question.
See, like, these are questions we got to figure out. If we're going to be using this moving forward, how is it going to be used? So we may have to follow crypto into the Forex world.
That'll be interesting.
Yep. When all the altcoins traded on the Forex market, just like the dollar and the euro, maybe they already are. I don't know. I'm not really into Forex, so I don't know. Could it be a commodity? It is mine. Could it be a commodity like rice?
That's a possibility too.
Don't just grow on trees. And even if it did, hey, oranges grow on trees. They traded on the market as a commodity.
Mm-hmm.
So what exactly is crypto? What exactly is crypto? That's what we got to figure out.
Yeah, I heard a couple different things of what the use for is supposed to be, but nothing concrete.
Mm-hmm. I'm not buying no Dallas Maverick tickets with Dogecoin.
You crazy?
You crazy? This thing ain't running right now.
All you doing is giving Mark Cuban more Dodge.
Right. That's a way for these companies to acquire more of it. If you buying cheeseburgers, and to be honest, a lot of people probably will be doing that.
It seems convenient now because they don't understand what that shit gonna do over time.
You basically paying for it with that's like going to buy something with some shares of Apple.
Right.
You wouldn't do that.
Yeah, no.
Like,
Just think about
okay,
who gave the shares to.
yeah, I sell you this
Better
shirt,
get your
but
shares on your own.
I sell you this shirt, but you gotta give me 2 shares of Apple. Is you crazy?
Right. Right. Think what that do for the person receiving the shares.
That's what I'm saying. That was my whole point. I said the restaurant's getting over.
Yeah, yeah. You know how much cryptocurrency they can accumulate if people buying cars with this stuff.
And then get this. Those people pay little to nothing for those coins. So now the restaurant really capitalizing 2 ways. You get more. You getting more because I'm giving you $12 worth of coins. But like I said, if I give you $12 in cash, it's only going to be $12 in cash today and tomorrow.
It might be less tomorrow when inflation.
Exactly. So therefore, now I give you 12 coins. Even if it go down, you're going to hold them. Them 12 coins, it can be worth $50. I mean, like $12 a day. It might be worth $8 tomorrow. But in 2 years, it's going to be worth $40.
Right.
You don't plan on for your business. Your business, you don't plan for it to go out of business, so you still gonna own them coins. It's not like you taking my coins and want to buy. It ain't like you paying your business bills with the coins.
Right.
You holding them.
Right.
All right.
You can't have my coins. Hell no. I give you $12 cash about your business.
Yeah. Crypto moving. Okay. So we'll move on. Coinbase IPO this week.
Yeah.
Big news this week. Coinbase IPO. Initially, they opened up around what, 380?
Right.
Out up the line like around 430, 440, something like that. Came back and settled in around. They currently at about 340.
They was playing around at like 320 for a little minute, like they were gonna sit there, but then they finally took off again late Friday and got back up to 340.
Right, they currently at 344. So I bought me a couple shares. I'm currently up 3%. And what I did was I waited. They IPO'd on Wednesday, and they ran up over 400. So I just waited for them to come down, which they did come down to about what, 320. They came down like 320. They bounced up to like 340. I bought one share, and then I waited for them to come back down. They came back down to around 325. I waited for them to bottom out. Like they found the bottom at around 325 and started to come back up. I bought another share at 328, lowered my cost basis. And I'm now currently sitting at an average cost of 334.
See, I got two on. I got one on IPO day. Got my head knocked off. Got one at 400. That shit went up. Thought I was in, and it came back down to like 313. And I grabbed the second one. And I just been chilling from there. If it go below that 300, I'll probably grab another one. Maybe around like 280, 270 or something like that. If it hit around there.
Right. It still could go lower than 320. You know, it's after the initial excitement, subsides. We may see it come down this week. We may see it come down and test that 320 again, maybe go below it. If so, I'll just average down. I'm already in. I just continue to average down. But a lot of analysts feel like Coinbase is going to be $1,000 stock soon.
Mm-hmm. I'm bullish on them myself. So I plan on riding them out for the long term too. So I want to grab my position early.
Right. Somebody who's also bullish on them, Miss Kathy Woods. Last week she purchased 19,599 shares to add to her ARC F fund. And she also purchased 112,539 shares to add to her ARC K fund.
Load me up, Captain.
Load us up, Auntie.
Uh-huh. Y'all don't know we've been talking about them, so yeah. Ain't no secret. We got positions in both of them plays. ARKK and ARKL.
Yes, we do.
So if you don't have enough to straight up go buy you some Coinbase, there go your two alternatives to get you some exposure to them.
Right. ARKK right now trading for 124.
ARKF.
Under $60.
ARKF should be at like $54, $55.
Yep, they $53 right now. Just under $54. So that's two ways that you can get exposure to the company Coinbase without actually having to purchase the shares directly.
Oh, also with that report of her buying Coinbase, a lot of people was trying to make some noise about the fact that she sold some of Tesla, but I feel like that's irrelevant. We know she been in Tesla for a minute, so if you don't understand that people take profit at some point in time, you still got a lot of catching up to do. That's
right.
That's all I see when I seen that.
Right. Like I said earlier, the end of last week, the market kind of dipped a little bit. And I suspect that, due to the Coinbase IPO, as well as this Dogecoin phenomenon, a lot of investors were taking profit, selling off some of their stock and taking profits to invest in Coinbase and Dodge. So we see Kathy, she sold some of her Tesla shares to get in Coinbase. That's pretty much par for the course.
Right.
At some point, she's still bullish on Tesla. She'll buy them back.
Nothing changed.
Nothing changed. It's how they rotate the money. That's why ARKF is a managed fund.
Actively managed.
Actively managed fund. She rotate her weights and percentages all the time. So
once we get to that scale or that level where we got that much money, we'll be playing the same game. Right. I'm not to that level yet. I do rotate, but I'm not on the same rotation cycle as them. Like, they rotate a lot. I don't got to do that. I ain't got that much money waiting in all these companies where I got to constantly be rotating my portfolio. Well, that's something else we want to talk about too. Getting out of all that rotating here, pivoting there. It's good to have your pivot plays, but you need to have your concentrated portfolio or focused portfolio. Have your few backups and stick to the script unless it's something drastic that's going on. We not these institutional investors.
Well, actually, that's how I got Coinbase. The same way I bought my shares of Coinbase. Mm-hmm. I sold some of my shares of VTI, a few of my shares of VTI, and took profit. I was up a considerable percentage in VTI. So I sold some of my shares, took that profit, and rolled it over to Coinbase. Now, hopefully, I get a run up on Coinbase, go up in profit, get enough to where I can sell 1 or 2 shares of Coinbase, take some profit, and then I can move that over to whatever else, whatever sector I'm bullish on at that particular moment, whether it be Dodge, by purchasing Dogecoin, buying shares of ARKF, buying shares of getting into the retail sector. That's how we do. We rotate the money. You rotate the money when it grow and we up. Always take profit. Take profit on the way up.
Right. We practice rotation, but don't get caught up in the hype of, oh, Kathy did this, or I got to rotate the same time she rotate.
Nah,
you don't got to move like that.
Yeah, your strategy what works for you. Kathy might be up. She might be up in Tesla to where she can sell off some of it, but you might be down in Tesla. Right. You might need to hold on a little while and average down. You might need to be buying more of it.
But if they go back and look, they talk about she sold some, but if you go back to the transactions, when they went on that dip down to 300 or something, she bought a hell of a lot of it too. Right. So they over $700. So if you buy in at anyway, if we had 1 share, no, just say we had 5 shares and you bought in at 3, you know they at 7. You might sell one of them.
I'm gonna sell one of them.
But to her, when you look at her, she's selling like a large quantity of them. Look how many she has though.
Right. right? When we say rotate, you see she sold some of her shares. She didn't sell the whole position. She didn't sell the whole position. You don't
sell the whole position. Then we'll be like, hold on, Captain, what you know that we don't know?
Yeah, then that's when my antennas will go up. But she just took profit like everybody do periodically.
Anybody else got anything they want to talk about this week before we get started with God for lesson?
Got a couple more things to hit. Retail rebounded. Retail rebounded in March, jumped 10%. The Fed said that it's the retail sector is increasing at a moderate rate. What we talked about earlier, sectors, that's the retail sector. Alibaba had a little run this week, up more than 5%. After fines were levied, they got hit with fines, but the fines came up under the estimate, what they were estimated to be hit with. So Alibaba looked like they rebounded nicely from that. Apple has an event on 4/20 called Spring Loaded. You know, they possibly be introducing new products. You know, so they got something cooking over there. So that's on 4/20. You might want to check that out. That's Apple. It's the event called Spring Loaded. The much talked about a free Tilray merger happened a couple of months ago. It looks like that merger will be closing on 4/20.
That's one I ain't know about right there. A free and Tilray merger.
Yeah, the news came out about 2 months ago, but now it looks like on 4/20 they'll be actually closing on that deal. And important, got earnings this week coming up. Last week we had the banks. We had the earnings for the big banks. A lot of the big banks, they performed well during earnings. A lot of them beat estimates, notably Wells Fargo, Citigroup. Earnings for this week include companies such as Coca-Cola, IBM, Johnson & Johnson, Procter & Gamble, Netflix, Verizon, Chipotle, American Express, and Honeywell. A lot of pharmaceuticals coming up on earnings this week, so be on the lookout for that too as well. But that's all I had.
Oh man, I like that earnings report lined up.
Yeah. Sean the Scalper just asked me a question.
I put it over y'all. Do y'all think Johnson & Johnson gonna go down since the vaccine is they had to pull the vaccine with the blood clots, and since they have earnings coming up, I think that's gonna affect their earnings.
Yeah.
So I
think it's gonna go down.
I think that news gonna hit them.
Now the earnings, I don't know how they usually react to their earnings, but I would expect that to negatively impact it. But the earnings, I don't think that's gonna impact the earnings for this report. That's gonna impact the next earnings coming up.
Oh, okay.
I think they already got the sales like
for this one.
Yeah.
Right.
Oh, it's too soon.
Mm-hmm.
Because the news just came out last week.
Mm-hmm. I'm waiting to see that react in the price. All right, so we're gonna go ahead and move to God for this week.
On this week's episode,
A little slide in there, something for that.
Yeah. Okay.
Long awaited.
Okay. Adventures of God, episode 9. We're getting into options trading. So this will be the intro, 101. First, we want to hit y'all with the disclaimer. Options involve risk and are not suitable for everyone. Options trading can be speculative in nature and carry substantial risk of loss. So we want to make sure we do our due diligence when we start options trading. Typically, I wouldn't advise a new investor to start out with options. I would rather you get familiarized with the long-term investing principles and build you a long-term base to add to in the future. But
get your fundamental understanding of stocks first and how they move before you start taking bets on what they're gonna do.
Mm-hmm. But you play this game at your own risk, so let's go. Okay, so what is an option? An option is a contract giving the buyer the right, but not the obligation, to buy or sell the underlying asset at a specific price on or before a certain date. So it says right here, it gives you the right, but not the obligation. You have the right to purchase those shares at any time during the contract, which will be called exercising the contract, but you're not obligated to do it. Options are known as derivatives. That's a key word, derivatives. That's a term to look up and get familiar with. Options are known as derivatives because they derive their value from an underlying asset. An option contract typically represents 100 shares of the underlying stock, but options may be written on any sort of underlying asset, from bonds to currencies to commodities. So typically an option contract represents 100 shares of the underlying stock that you're purchasing the contract on. So calls and puts. These are two terms. These are also two terms you need to get familiar with. A call is a call option gives the holder the right to buy a stock. Conversely, put options give the holder the right to sell a stock. So another way to look at it, call options when you think that the company's price is going to go up. Put options are when you think the company's price is going to go down. Your strike price, you see my boy, he look like me right there, don't he?
Hey, strike them out, splash, brother.
Strike them down, splash, bro. Strike price. The strike price is the price at which the buyer of the option can buy or sell the underlying security if they choose to exercise the option. Remember I said earlier about exercising the option. You have the right to do that, but you're not obligated to. Right? So the strike price is where that's the price that you would set that you would buy or sell it at. You would buy or sell the underlying asset at. Premium. An option premium is the current market price of an option contract. These prices do fluctuate. As the underlying stock price fluctuate, these premiums will change. Quoted as a dollar amount per share and represents the commitment of 100 shares. So anytime you see the premium price may say 50 cents. That price is always times by 100 because it's representing 100 shares. So you would multiply 50 cents by 100. And that option contract will cost you $5. A 50-cent contract is equivalent to $5.
Nah, $50.
$50, my bad. $50. Moneyness. This term refers to how far away the underlying security price is from the strike price. Out of the money is a term that means the underlying security price has not yet reached the strike price. At the money means the underlying security is currently at the strike price. In the money means the underlying security price has exceeded the strike price. So if your strike price is $40 and the underlying security price is currently sitting at $36, what is that? Where's that contract? What's the money?
Out of the money.
Right. It's out of the money. It has not yet reached the strike price. Go ahead.
I was just gonna say, just to clear up any confusion, underlying security is just simply the stock, because most of the options that we trade is gonna be based on the stock. You put an option bet on the stock.
Right. Right. If you got options on Apple, Apple is the underlying security. Okay, at the money. If my strike price is $40 and the underlying security price is currently at $40, then my contract is at the money. It's right at the money. Anytime it moves above $40, then I'm in the money. These three terms are commonly used when it comes to options trading. So know what they mean.
And a note, out of the money contracts are usually cheaper. The closer you get to in the money, the more expensive the contract gonna be.
Because the less risk. The further out of the money, the further you, the more risk you incur on that particular contract. So they'll be cheaper. The closer to the money, or the closer you can get at the money, or actually in the money, those contracts, the premium for those contracts will be significantly higher because they incur less risk.
Right.
Also, well, I'll get into that later.
Okay.
Okay, extrinsic value. Extrinsic value is the difference between the market price of an option, which is the premium, and its intrinsic price, which is the difference between an option strike price and the underlying security's asset. Intrinsic value rises with increase in volatility in the market. So we're talking about extrinsic value. If I buy a contract and my strike price is $40 and the company is currently trading at $32, that the price doesn't have to actually hit 40 for me to gain value on those contracts. As long as the price is trending towards 40, that contract will start to gain value, which is known as extrinsic value, because it's not yet in the money. So as the price approaches, as the underlying asset approaches $40, the value of your option contract will increase with extrinsic value.
Right. Any questions? Everybody got that? Y'all understand what he's saying?
Yeah.
So say, for example, my strike price is $40. The company currently sitting at $30. Let's say 3 days go by, the company went on a rally, and now they up at $34. My $40 contract has increased in value due to the extrinsic value of the underlying asset. I'm not even at the $40 strike price yet, and this contract already holds value. I can sell it for a profit right now. Option chain. What is it? An option chain, this is another key term that you will often hear referred to. An option chain is a listing of all available option contracts for a given security. On this option chain, you will see key things like the strike price, the bid or the strike price, which is if you look on the picture, the strike price is right in the middle. You can't really see all these things from the picture, but we'll show you a live option chain later.
Right.
The strike price, we went over that. That's the predicted price movement, where you think that the price will eventually hit. You'll see the bid ask.
Hold on, the strike price means two things. It's the price where you betting that it's gonna go to, and it's also the price where you will buy the shares if you choose to exercise the contract.
Right. So that's the strike price. Then we got the bid ask. You'll see the bid ask on the option chain. The bid ask is just the difference between the buyers, what buyers are willing to pay versus what the sellers are willing to sell it for. So your depending on where you buy the contract, you may be closer to the bid or closer to the ask, depending on where you choose to buy the contract. Expiration, that's the end date of the contract. That's the date that you think that the underlying asset will hit your target price either on or before. So for example, if we look at the picture, we looking at option contracts for May 21st, which happened to be my birthday. These would be all the contracts with the expiration date of May 21st. Now, when you buy an option contract, you don't have to hold it all the way to the expiration. The expiration just gives you time in order for the underlying asset to do what you think it needs to do, whether that be rise or fall. That's just giving you a time frame. You can buy a contract for May on Monday and then turn around and sell it on Tuesday. You can sell it whenever you feel the need to. Implied volatility will also be shown on the option chain. Implied volatility just refers to the volatility of the underlying asset. Some companies' charts are more volatile than others. For example, Tesla is a very volatile chart. The more volatility, the better, because you want the wide price swings when you trade in options. So if you look, contracts for Teslas are typically more expensive because they're more volatile. It's a more volatile underlying asset. The more volatile the underlying asset, typically the more expensive the contracts will be. Volume. You want to take note of the volume of the contracts. That simply refers to the number of traders that's actually trading this company. Open interest. Open interest refers to the number of open contracts that are currently on this company. So if we look and we see contracts for May 25th with the $80 strike price, the open interest will tell you how many other investors also have that contract and it's open and active. So typically when you're looking at an option chain and you see an option contract with a lot of open interest, that's something to take note of. It's a lot of money betting on this contract right here. Open interest. Also, what will be shown on the option chain is the Greeks. The Greeks, we'll have to get into the Greeks probably maybe next week, or after this, probably next week we'll go into the Greeks and what the Greeks mean. But the Greeks will tell you the speed and acceleration that contract will grow as the underlying asset goes up every dollar. So we'll get into a quick breakdown. I got a great video. I might just post it in the Discord that'll break down the Greeks and what they actually mean. The premium, which is the price of the contract, will also be displayed on the option chain. That's the price that you would pay to purchase that particular contract. Like I said earlier, depending on the underlying asset and the price fluctuation of the underlying security, the premium, it changes. It fluctuates as the underlying security fluctuates. So if I can buy a contract today, tomorrow you come back and buy that same contract, it'll be a different price. That's why timing is key. Why do we trade options? There are three main reasons why we trade options. I added the fourth. The first one is speculation. Anytime when you You know, options are based on your particular speculation on how you speculate this company will move in the future. So options are very speculative in nature. Leverage. because every option contract, it represents 100 shares. Option contracts give you more leverage as opposed to just owning. If you own 1 or 2 shares, shares of Amazon are over $3,000 a share. You know, we 9-to-5ers. Not a lot of us have a lot of money to just buy 100 shares of Amazon. But we can move 100 shares of Amazon through options. So options give us the ability to move 100 shares without actually owning them. And that's leverage. Hedging. Hedging is a form of insurance on your investment. It's also one of the main reasons that we trade options, because options provide a great hedge for our long-term investments. For example, if I'm long on Apple, or I'm planning on holding Apple long term, and I buy shares of Apple at 130, I could also at the same time buy a put contract with a 130 strike price in the event that Apple's stock price drops after I buy these shares. So the put option gives me insurance in the event that Apple takes a downturn. So these are the 3 main reasons why we trade options. The 4th is for income. A lot of options give you the ability to make a lot of money very quickly. You can use that for income. A lot of people day trade options or swing trade options, and they generate weekly income or even daily income every day. So,
any questions y'all got on options? Anybody?
Any questions?
Good job.
Anybody in here has yet to trade options?
Yep.
I have never traded options.
Okay. You plan on trading options?
I do.
Okay, you just trying to get a little more understanding of it?
Yes, I'm trying to get a little bit more understanding, and then I had to actually put my money into TD trade, because I guess that's where it's trade. Y'all do it, right?
Right.
Yes. So I had to. I think it's still settling.
Right. Well, this week we actually going to look at some option plays that Godfrey can get into. We may look at a few leaps. Few swing trades that Godfrey can get into. I advise anyone who's new to options to look at long-term contracts. The longer, that alleviate a lot of the risk. So long-term contracts, what we call leaps.
Okay.
Anything 1 year, 1 or 2 years out, I will start there. And this week we'll be looking for some leaps for Godfrey to play.
Okay.
Let's pull up a chain real quick.
Right. Let's pull up an option chain.
So once you get on the Thinkorswim platform, well, we're gonna look at one for Apple. We're gonna type in your company up here. Everybody can see my screen, right?
Right.
All right.
Yes.
Then we hit trade. This is what we call the option chain. Now over here, the expiration dates. We'll look at weekly right now. So right here, you see it say strikes. This is the strike prices. Strikes, they got different. Well, I see they're doing $5, $1. Different companies gonna have different increments between the strike prices. So over here to the left, since Apple is currently sitting at $134, all of these strikes, that's below $134 is considered in the money. So you see they highlighted. These are in the money. These puts, since Apple is above it already, they consider out of the money. So they're not highlighted. Call side, put side. And they tell you at the top, calls, puts.
Right.
Now, when we go down, we say Apple at $134.16. So $136 is considered out of the money. The bid is what the people who currently have the contract are looking to sell it for. The ask is what people who are trying to get the contract currently looking to buy it for. So if you were to buy this contract for $136 for April the 23rd, that's the expiration, you would click this one where it say buy, and it's telling you the price you would pay. This is your premium.
That's the premium right there.
So it says $1.12, but like we went over in the video, in the presentation, you will multiply that by 100. So this contract will cost you $112. So for $112, you have the right to control 100 shares of Apple, as opposed to paying $134 times 100 to own 100 shares.
Right.
So you already see the cost advantage in purchasing an option versus owning the shares outright. Now over here, we got what he went over, open interest. This lets you know how many other people are betting on these same contracts at these same prices. The one with the highest open interest right now would be the $140 call. And that one would cost you $32. 32 cents times 100 is $32. What are they going for that one? 140. That's interesting.
So this Friday?
Yeah, for this
It'll
Friday.
be the
Oh, that April 20th event. Yeah, so that could possibly be one reason why a lot of people betting on this. That news for the April 20th event, they betting on it to go to 140.
That's a catalyst.
Right. I might hop on that one.
What
That's
the
$32.
150 going for?
The 150 going for $4. It's 4 cents. You multiply that times 100, that's $4.
What's the open interest?
Open interest on that is $8,000.
What was open interest was 140 with 56,000?
Yeah, 56.
Gotta show what y'all looking at. Gotta show what y'all looking at.
What you say?
You gotta show them what y'all looking at. Okay, you said the open interest.
Oh yeah, the open interest for the 150 strike on April 23rd, the open interest is 8,000. Now we was looking at the 140 strike price for April 23rd and the open interest 56,000.
Now you see that? You see that open interest? You see how many contracts out there? 56,000. Now look at the other ones as opposed to the other ones. You see 2,000, 3,000. You see that 56,000 spike right there? You might want to take note of that. That's a contract that a lot of investors like.
And it only cost you $32. So I'm pretty sure everybody on this call got $32 if they wanted to take a bet on Apple and potentially make some money next week. I'm not telling y'all to, but I'm just letting y'all know how realistic it is for y'all if y'all wanted to play options. Like, it is affordable.
Right. So what's the strike on that?
$140.
Okay, so Apple, let's say, okay. So if you playing a contract, this is what you saying. Apple is currently at 134.
Right.
So what you betting on is that Apple approaches 140, possibly breaks over 140 by the end of the week.
Right.
And you're going to pay $32 for that contract. Now, let's say they at $34, right? Let's say you buy that contract Monday morning. Let's say by Wednesday, Apple sitting at $39.
Price on this contract gonna be went up from 32. It's gonna go up drastically. Now,
yeah,
we could get into breaking down exactly how much of the move I don't think it'll take too much. We'll just.
Yeah, Latriva had a question.
But let's say this, right?
Oh, hold on real quick, G. She said Latriva had a question. What was your question, Triva?
I was just wondering, like, for instance, with that one that had the 56,000 people trying to get into it, does that mean that you won't, like, if you were to buy it for the $32, does that mean that you have to wait to see if you actually get it, or do everybody that's in it get it?
No, that's actually the opposite. The more open interest and volume you have, the easier it is to get in and get out.
Oh, okay.
The 56,000 is not people who trying to get it. That's the people who actually in it.
Yeah.
Oh, okay, gotcha.
Open interest means they already got the contracts. They just haven't sold them yet. That would be closed interest. They currently waiting on this price. They sitting on it right now.
Right. The higher the open interest, the easier it is to move those contracts.
Okay.
You don't want to buy contracts with zero open interest.
Okay.
Because then there's nobody to sell it to on the other end.
Gotcha.
So you want a lot of volume. You want a lot of open interest. It's almost like at the casino. You go to the crap table. You're gonna want to go to the crap table where it's a lot of people at around it, because it's more bettors, more opportunity for you to get a bet, more opportunity for you to win a bet, as opposed to going to the crap table where there's nobody at. You don't want to be the only one at the crap table, because then you betting against yourself.
Right. Got it.
It's the same analogy. High volume, high open interest. Anytime you see a spike like that, 56,000, you might say, you might want to look into that.
Any other questions?
So now say that contract for 140, right? Say you buy it Monday morning. Stay by Wednesday, Apple at 145. You don't have to wait until the end of the week. You can sell it right then if you think that they're going to top out at 145, because a lot of time what happens, they'll go up and then they'll come down. So if you think they're going to top out at 130, at 145 peak, you might want to sell right then and take your profit. You don't have to hold them until the expiration. You can sell them at any time, as long as the market.
And another thing you want to look at, if you're not really too sure what it might do, I'm not saying it's concrete, but you could use it. Look at the numbers on the open interest side for the calls, and also go look at the open interest side for the puts. I don't really see a lot of high, this volume, my bad, open interest over here. I don't really see a lot of crazy numbers on the open interest for the put side over here. Now, if I go to the call side, you see 40, 13, 13, 9, 6, 56, 13, 8.
Yep. That's where a lot of the money at. All the money on the call side. So most people feeling bullish on Apple, they think that it's going to rise. We follow the trend. We trade with the trend.
Right. So that's just a basic intro to options. Let me see what my Greek said.
Oh, that's another thing I want to tell you. In options, you can only lose the money that you put in. So that $32 contract, $32 is the most you can lose. But on the flip side, your potential profit is theoretically unlimited. Apple could keep going up and up and up and up, and your profit could be limitless. So you're only risking $32 for the right to control 100 shares of Apple.
Okay.
This is why options so powerful. You can also mitigate those risks by placing stop losses on the contract. So of that $32, you can say, if I lose 10%, I want to sell it. So if you buy that contract and it turn against you, and you go down 10% real quick, That stop loss will stop you out. You save the rest of your money. You go on to the next trade.
Okay, that's what's up.
Any questions?
Thank you. Good information.
Anything else you want us to look over or explain?
Just remember, it's a tool or a solution for every problem. For every question, it's an answer. We just got to find it. It's already out there.
Hold on real quick. Let me show y'all one more thing. I'm going to show y'all the difference between taking some short term options versus the long term options, the leap. The price difference. All right, so we just looked at the 140 call for this week. So let's go to some leaps. I'm currently in, not the one I'm in. Let's go to September. So let's say we go to September on the leap. And we wanted to take a $170 strike price to say that Apple would be at $170 by September. The premium here is only $1.86. So multiply that by 100, you're paying $186. If that's too much for you, 180, the strike price would, the premium would be $123. So we went all the way to September. Is what, April right now. And it only costs $123 to get a contract on Apple to go up to 180. And like we said, it don't even really have to reach 180. If Apple start correcting itself and it's around 150 or 160 by the time, or a little bit before your expiration, you still gonna make money. But it's only gonna cost you $123 to get in.
That money you gonna make, we went over that. That's called extrinsic value. It's extrinsic because it's still out of the money. Now, once that contract gets at the money and into the money, it starts to grow. It starts to grow at an accelerated rate because you now picking up not only the extrinsic value, but you also getting the intrinsic value combined with that. So the contract will grow as it approaches that strike price, but once it hits and exceeds that strike price, that contract will start growing at an even accelerated pace. So the goal is to get a strike price that you are fairly certain that the company will exceed. But even if it doesn't exceed that strike price, you can still walk away with a profit.
Yep. And you get more comfortable with taking, I mean, to me, the longer the expiration, the more comfortable you can get inside your contract, especially when you know it's a company that's a productive company that usually growing and moving up.
Right.
A company like Apple, for myself or for God, let's say we take a leap for God and we wanted to take one that wasn't too expensive. I would take the January 2022, the volume, these two close for where they're going to be at by January. That's why you can see the premium so high. They already know it's going to be in this range by then.
Right.
But we want to go a little out the money. If we were to take a $200 call for Apple January 2022, the open interest is $57,000. It'll only cost $185. If Apple come to fall short and don't reach 200, okay, we can show y'all this. This will be a second part of what we're at. The option strat calculator, how we can start to calculate profit. So we're gonna pull up this same exact contract, the 200 strike price for January 21st, 2022.
And this how you can determine what the contract would make in the future. What would be the value of it in the future? If the price.
The website is optionstrat.com. I will pull it up so y'all will see it in the search bar. You could just type it in and save it on your computer. So I'm gonna take y'all all the way to the beginning and show you how to use it. Optionstrat.com. That's what it's gonna look like when you pull it up. Build a strategy, create a call. Over here, we type in the ticker symbol, alpha. This your expiration, January 2022. We're gonna click that. These your strike prices down here. Gonna move this to where 200 is. $200 call. Come down here. It says days until expiration. We're gonna simulate it as if we in September.
Wow.
All right, we'll do it closer down. We can do it whatever month I want to simulate. We can simulate a month. Give me a month.
Just say we buy it right now.
I know we buy it right now, but days until expiration, and let's say Apple went up some.
Oh, you saying the day that we probably would execute, like we would get out of it?
If you wanted to, you're just looking at potentially what your contract could be worth.
All right, do September then.
Okay, and I want y'all to take note where it say max loss up there at the top. That's the most you can lose right there. The price you paid for the contract.
And it's the same number we seeing on Thinkorswim, $182. So that's the exact contract we were looking at.
Now look at the max profit. See what it say on the max profit?
Infinite.
No limit. Master P.
So just for example, let's say we got it set for Wednesday, July 7th. Let's say Apple happened to be at $170. You see how much profit you'll be making on that contract? Y'all see that number, 543?
And you ain't even hit the 200 yet.
That's how much you'll be up, and you ain't hit your strike price yet. But let's not say that it had a crazy move like that soon. Let's take it to August. We'll take it to the end of August. Take it to the same 170. 170, between 170 and 175, you're making between $400 and almost $500.
$500 on that contract.
And you only paid $182. Now, let's go a little bit further. Let's take it to October. And let's say they're getting close to where we need them to be. They around 190. At that point, you up $722 and you only paid $182. At this point, if you wanted to, you could take profit, or you still got 97 days until expiration. You could continue to let that run. We take it to November. Our expiration is in January. Hopefully, okay, let's say we having a good year. Apple already at our 200. We up $900, almost $1,000. If it still ain't there yet and it's at 190, we up $537. Still, you only paid $182, and you got more time left to let it run.
Yeah. Now let's say Apple go crazy and it hit that 200.
Okay.
What's the contract worth once it hit 200?
At this point, on November 12th, if it hit 200, you'll be up $984. If it tipped past 200 to just 210, you up $1,500.
So you paid $182. This why people play options.
And then that's just for one contract. If you had a budget of 400 and you brought two contracts at that strike price, you just double your money. You'd be up almost $3 grand. Well, $3 grand.
Yeah, you'd be up $3 grand at that point, off of almost $500 or $400 invested.
So when you hear people say they made $12,000, $17,000 in 1 month, this is probably how they did it.
They got a nice leap and it popped earlier than expected. Because the further it go past your strike, you start to make a killing. If it go to 220 and it's November, you made $2,300 on this contract that you paid $182 for.
Right. That's some serious income right there.
Yeah.
And let's say we take it to December because it expires in January. January 21st. If we take it to December and let it continue to run, and it go to 220 still, that's $2 grand, 1984. If it, oh shit, it better not go to no 240. If it go to 240, you making $4 grand.
Come on, 240. This is a contract I'm currently in right here. The $200 call right here. I got this exact contract.
This is a good way to map out some of your trades. If you got it for a long term and you're looking to get out or find some potential pivots, you use this little calculator, put in what date you might expect it to be at a certain price, see what your profit looking like, plan your next trade.
Right. So now you in profit on that. That's why I say options can provide income. So you take the profits you make from this contract, and then you add on to your long-term shares of Apple with that money. So now you investing with house money, and you rinse and repeat the process. This is just one contract. There's no limit to the amount of contracts you can buy. The only limit is your budget. So you could have bought, like you say, you could have bought 3 of these contracts and been up times 3. You could have bought 2 of these 200 calls, and then you could have bought one further out the money for cheaper. 205, 210.
And if we want to simulate it, we could add the quantity right here. Let's do 3 of them.
Yep. If you did 3 of those, if you bought 3 of those contracts,
it cost us $546. Oh, baby. Look at that 200 number. Look at what it's going to make you if you hit 200 by September 9th. That's $4,341, and you only paid $546.
Right. You paid.
God damn.
It's about a car payment. That's a new outfit of some shoes.
Yeah, I think I can afford to take a couple of these.
You know, one contract, you paid less than a pair of Air Jordans.
September correction period, so let's get past the correction. Let's go to October. October 200, you still made $36.85. God damn. Yeah, I can live with that. That's just one trade.
And because it's the expiration so far out, you got time. You got time to let Apple do what it's gonna do.
Why you calling that?
Yeah. Y'all understand how I use that? Anything else y'all want me to go back over real quick?
This option strat website, they got an app. They got a phone app. So you can add the app to your phone.
Oh yeah, thank you so much.
Yes, that was good.
That's how you calculate where your profit will be. But as you can see, the amount of money you can make trading options is significant.
It's a game changer for real.
But be careful.
It's significant. Now going back to our future 9-to-5ers, they were showing you how to find support and resistance on the chart. Charting is key to finding good entry points for contracts. It's when you marry the two. When you take your technical analysis, the better you get at your charting, the better you can pick and choose contracts and get your timing down. Because timing in buying these contracts is key. So the better you can become on the technical side as a charter, the better you can pinpoint the exact times to buy these contracts, which will increase your profit.
And one last thing on that option that's important to why a lot of people like to trade them, the multiplier. Let me show you the difference of what you would have made. So let's say $546. I'm gonna pull up a calculator. Now we see what we could have possibly made if Apple went to 200. Let's put it on 200. $3,627.50. All right, we're gonna remember that. If we would have took this same $546 and bought shares of Apple instead of the contracts, let's look at the difference. 546 divided by 134.15. You would have bought 4 shares. So 4 shares. Now it's at 130. Oh, it's at 134. It would have went to 200. 65.85. So we're gonna multiply that times your 4 shares. You would have made $263 if you would have bought 4 shares of Apple with your same $546 budget, as opposed to putting it into them contracts and to get to the 200 price. You would have made, what was the number? 3,000, basically 3,500. That's a hell of a difference.
Yep, that's a hell of a difference.
Then you can come back and you cash out and then buy your Apple shares with the money.
And go buy those Apple shares with that free money.
I don't even have to get into percentages. You can definitely see you would have made way more in percentages doing this contract than you would have buying the shares flat out.
So that's the power of using options, and that what he just described, that's leverage. That's the added leverage that you get. The more leverage, the more you can, the more leverage you have the right to move 100 shares of this company. You can make money just off moving them without even having to own them.
That's it, man. If nobody got any questions, that's the options lessons for the week.
Yep. Once again, this is the 9 to 5 Investor Sunday service. You know, for those following us on YouTube, you know, hit the like and subscribe button. You know, share this with your friends and your family members. You know, we trying to build wealth one family at a time. Tune in. We appreciate the support. Any comments or anything, any interaction, we greatly appreciate it. If you have any questions, you can leave it in the comment section and we'll try to get to them as best we can. Like, share, and subscribe. This is the 9 to 5 Investor Sunday service. I am yours truly, Mr. Legendary.
And I'm Mr. Smart Money. The Splash Brothers wrapping it up, man.
Yeah. Oh, and we
Thank y'all so much.
Also, look out for us on Facebook. You know, the 9 to 5 Investors Facebook group. We got the Facebook group and we got the Discord. So check us out.
All right, y'all. Peace.